Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. And good morning, everybody. Thank you for dialing in again to our monthly webinar, which appears to have been a lot more popular this month than previous months. I can't, for the life of me, understand why that is. But hopefully over the course of the next 45 minutes or so, we'll be able to give you a good overview of some of the moves that have occurred in the markets and some of the macroeconomic changes that we've been seeing as well. We're going to do things slightly differently this month. So I'm going to ask for Piers to present first, mainly because it's the end of the quarter that he's looking at, and I think there have been some really interesting market moves that we need to highlight. So Piers, if you're ready, then I'll hand over to you. Thank you.
Hi Neil, thanks very much for that. Yes, so there has been a lot go on and we have a lot of slides to go through. So I'm going to talk quite quickly. Don't worry if you don't catch it all. I've written it all out, so when the slides get sent out to you afterwards, you will be able to read it. But I'm going to go quite fast because we only have a quarter of an hour. Right, so on the first slide, I'm going to start with the dollar index. Now, this is a chart I put out in April. It's important to look at the dollar index because the dollar is the world's main traded currency and it pushes everything else around. One of the big reasons we saw cable down was this dollar index going up. So I put this out in April's webinar and said, look, price had broken above the cloud and the lagging line had broken above the cloud. First time that I can see that that's happened, since the 90s. Even the financial crisis, the dollar wasn't that strong and didn't manage to break the cloud. So we've seen a huge acceleration away. It's broken the downtrend and we've had a huge move up. So that is really what's caused this move up in the dollar we've seen this year. But if we go to the next slide, we'll see just one other thing, that there's a bit of a spike on last quarter's candle. So it sort of suggests maybe it's entering a period where it might be starting to stall a bit, the dollar. But that's not unsurprising because look at it, for the last 7 years, you were in a range, 38 to 61.8, and it just went sideways for 7 years within that trading range. This year, the break of the Ichimoku cloud, the power taking it up, it went through the 61.8% and it went through the 78.4%. So very strong dollar. So it's just really getting to, if you look back at 2000 on that chart, the area where it started to stall then. So I think we might start to see a bit of a slowdown in the dollar, not a complete turnaround, but just a bit of a stall and pullback. So the other thing on this chart, there's two red lines going across that widen and narrow. They're called Bollinger Bands. They're widening out as this move has gone up. So I think that indicates that this is going to go further up. So I think that moves coming back down should find support in the sort of 109 area, 108, 109, and then probably down in the 101, 105 area. And only below 99 would I start to think that this dollar move was wrong and we might see a weaker dollar. Remember, we're talking big picture here. But if we go to the next slide, we'll see here's the extension swing. So we can look at the move up and then extend on and project where we think it's going to go. You can see that it's done these extension swings quite nicely, but it's just got to 76.4% and starting to stall. So that's 113. The 100% is 121. So I think between this 114, 121, I think it'll be a bit tougher for the dollar in there. So, but remember, I think that at this stage, pullbacks, 108, 105 area should find support. Only below 99 am I worried about it not being a strong dollar world. So we go to the next slide. We're going to look at euro dollar. So euro dollar is all very nice and easy. Same chart as I've done before. We had this in June's webinar. Same sort of story. I was looking for a move down to the 97 area, that we've got to move to the 97 area. And I said that I thought at 97, we could see some support arrive and we could see a bit of a move back up. But if we do see a move back up of this 97, the 50% extension, I think that 38 to the 104 and that horizontal line I've got at 107.60. So 104, 108, I think that should hold any rallies. And only above 109.50 would I start to think something's changed that I haven't been ready for. But at the moment, I think a small rally off this 90 area bit of a rally back up, but I still, of the 97 area, but I still have that 90 area, the 61.8% as a target for it to come down to. So if we go on to the next slide, this is probably my favorite slide. If you trade sterling against any currency and you don't look at this, you're going to look back and wish you had. I put this on every webinar we do. You know, it's such an important one. It's sterling. It shows the collapse. Every rally since the collapse has stopped at 38.2%, and it's fallen off. So when do you get positive? Over the last, 7 years, I've heard so many times, sterling's rallying. It doesn't rally till it breaks that 38.2. So what happened? Back in April, I think it was that webinar, I highlighted in April's webinar, I highlighted the bearish outside session had just formed in the sterling index. And that said a weaker sterling. So you can see off that 38.2, the bearish outside session, what's it done? It's weakened, it's fallen off. Now, the risk I was saying was that you might go down below this 23.6%, the 62 area. So we went down to that, and the first quarter, it managed to hold it. But last quarter, you've rushed below it. And I said that there's a risk if you got below that 23.6 of a new test lower. And you got that test lower last quarter. And it went down nearly to the flash crash of Brexit. But it managed to rally back up. So it has one saving grace, the huge spike on the bottom. And that might save it. But what do we know about this chart? We know that you're down below that blue dotted trend line. That's not good. So you've got that blue dotted trend line, you've got the 38.2 and the 23.6 acting as resistance. And if you want sterling stronger, you need it above there, because the risk is that it continues to fall off that 23.6. So a move lower. Now, if you do get this quarter, continue this move lower and close lower than this quarter, then I think sterling's on for new lows. But we've really got to watch this quarter. That spike has really put a spanner in the works a bit, but it's looking negative. It doesn't look positive. It might be going neutral, slightly positive, but until you get above that 38.2, I can't get positive sterling dollar. So why is that all important? Because if we go to the next slide, this is just worth looking back, because I think a lot of people think, who is this warm-up act for Neil? This sort of guy who comes on and talks stuff with no sort of substance, maybe. But I think it's important because in June, after that April, we had that collapse on the sterling index. We put this chart on the webinar. And if you put it on a line chart, which I don't put on often, you'll see you broke that line chart. I circled it in that purple part. And I was saying that was the first negative sign. And if you got below 23.59, it would be very negative and open up 113, 114 area was the target. Now, it's very interesting because at the same time I was saying that, the strategy desk had 131, 135. So the rates Neil has to read out were 131, 135 for sterling dollar for quarter three, quarter four. And I'd just like to explain why that's different, because some people ask, why do I give such different views? Actually, I do remember Neil didn't agree with those 131, 135. He was down more 118, 120. But the 131, 135 comes from where they look at research and they look at forecasts and they look at government estimates and they say, oh, well, we think this is going to happen with inflation, interest rates. Whereas I look at just price. And if price is breaking lower, I don't care what people say is going to happen to interest rates, inflation. The market's selling, and it's that simple. But I just want to explain that because some people have asked on some of the webinars why we have such different sort of forecasts. So now, what can we look at now? We know that worked. We got down to the 113. If we look at the next slide, we can look at the sterling dollar roadmap since 2007. And it's been quite simple. It's just been a downtrend. All it's done, it went down, and then it rallied back up to 172. And then it started to fall off. And if you got my charts in 2014, 15, I was talking about a 130 area to come. And this is the chart I was basing it on. And you can see that we've come down. But look at the 38 and 32. Now, if we go to the next one, it might be a bit easier to see. Yes, I've zoomed in here. But the important thing is, since 2007, sterling dollar is in a downtrend. It's made lower lows and lower highs. So that is the classic definition of a downtrend. And let's just look at that 38.2 and 61.8 and 76.4. They're levels I go on about, the 38.2 and 61.8 a lot. Look at the rallies. 2017, where did sterling dollar stop? 38.2, 142.60 area. 2021, same thing, it stopped at that. And then when it fell back down, it usually ended the quarter around about the 61.8%, managed to hold on to that, the 124.60. By the end of the quarter, people bought it up. So you have those two big spikes down to the 76.4%, which is 113.43. So the first spike down there was Brexit. The second spike was when COVID hit. So why do people look at this? Because when prices go down to new low levels, people have to try and find where should the market stop. You know, they want a roadmap. And so that 113.43 has been very important. But last quarter, we did close below it, but only just. And I don't like that spike on the bottom, because the spike, if you look back at the 61.8%, when it has a spike on the bottom, quite often has a bit of a rally back up. So maybe we're going to see a bit of a rally back up. But I do feel at this stage, though, that the downtrend is intact. So where would I look for rallies to sort of struggle? I think sort of maybe the 115, 118 area, we could see it get to there, but start to struggle there, maybe at a push up to 122. But where would I say I'm completely wrong and something's happened that's just not on my radar and sterling's going to strengthen right back up? I think that's more if you take out that 61.8 at 124.60. I think if you get over 127.50, then that spike will be more than just a bit of a saving grace this quarter that it managed to rally up. Because the close, when you look at it, it isn't that conclusive to be below that 76.4. It is below it, so it could still trigger some people just to sell sterling dollar. But I think rallies will fail. So I think it will go up and then test lower, is my sort of gut feel looking at this chart. So if we look at the next chart, this is just putting Bollinger Bands on it and showing the retracements. So hopefully on there, you can see the 61.8 comes in that 127.52. Might be hard to see on this screen, but when you get the slide, you'll see it. And that's where I'd start to sort of change my view on sterling dollar. But the Bollinger Bands are widening out as this move goes lower. So that suggests to me the move lower continues. I could be wrong, you know, above 27.5, I have to say I'm wrong. If you knew my wife and kids, they tell me I'm wrong every day. So it could happen. But above 127.5 is where I'd say I was wrong. On the next slide, I go on to euro sterling. Now I have to do that trick that Neil likes. Neil tells me everyone likes sterling euro, not euro sterling. And then I talk to people and they tell me they like euro sterling as well. So I'm going to try and cover both. So I've put the same chart, just flipped it round. So on the last webinar, I said that there was a risk of going to 87.38 and then 87.90 and 88 can't be ruled out. Now, price spiked up after the sort of crash after the mini budget up to the 92.70 area. So you had that huge spike. But by the end of the quarter, it had come back down to 87.75.80. So just below that 87.90, 88 area I had as resistance. So at the moment, I would look for this because you've got a huge spike on the top and a bit of a spike on the bottom. It's a bit stuck sideways. And I think what we have to do is watch this one as it goes along. And this quarter, I would watch 88.95. I'd keep that as my top level. And on the bottom side, I'd put 85. And I'd watch how price trades within that. If it starts to break out of either of those two extremes, then I think the market's starting to take a more directional feel. If it goes up through it, 88.95, the market's starting to feel right. We're going to push to the upside. And if it breaks down below 85, you'll get a test on that 84, that strong 38.2% retracement area, which has held it in the past. If we look at the next slide, So on the last webinar, I said that that the risk was 114.44 and potentially 113.60.70. And price crashed lower than that in the sterling mini budget crash. And we got down to the sort of 107.85 area. But by the end of the quarter, we closed at 113.90, which is important because it got above that support that I gave, 113.60, 113.70. So while it can hold that, I still sort of see maybe on the downside, I'd move it a bit lower and say maybe the 112.40 area up to the 117.65. I'd watch that as a trading range. Any sustained price action outside those, then we need to start thinking. And all I can say is try and get on my chart distribution list. I send the charts through. Hopefully you see them. If not, we do these every month. And hopefully that helps. That's where we're going to get the quicker updates. I think at the moment, you can't just sit here and think, right, this is a quarterly chart. I'll wait till next quarter or I'll wait till next month's webinar. You need to be more on top of it. Now, the last two charts that I'm going to try and whiz through quickly. The first one is S&P. We're in Manchester. Someone asked, could I redo this? I did this last year saying I thought the stock markets looked very heavy and we're going to go down on the S&P. So here's the update. The beginning of the year, we had a hanging man candle, very negative. And then we saw after that negative candle, the market crashed down and it broke through the 23.6. Last quarter, the price tried to rally back up into that negative quarter previously, but came down to close and it closed below that 23.6, whereas the month before it managed to hold on to it after crashing below it. So I think that at the moment, that rallies in equity markets will fail. I know it's all rallying now and it all looks good, but I see a sort of 3,800, 4,100 area as one resistance area. Maybe it gets up to 4,300, but only above 46.30 would I say it's lost the negative feel. But where do I think that American markets go? I've just done the S&P just as one. I think that the risk is down to 3,200. So down towards that 38.2. And then the final chart I've got on here is the FTSE. And the FTSE, again, you have a trend line going up since 2020, since the COVID panic. And as you look at it, you'll see that it suddenly breaks below it. And it breaks below it and closes below that trend line with what's called a bearish outside quarter. Higher high, lower low, lower close. So it wipes out the previous quarter. And in fact, it wipes out the previous quarter of that. So for half a year, it was wiped out in 1 year, 1 quarter. So all the gains of half a year wiped out in 1 quarter, very negative. The next quarter, it tried to rally back up. The next quarter, it tried to rally, but then fell back down as it got towards the top of that bearish outside quarter. And then last quarter, bang, it went down. So you've got a gap, 7,265. I know the FTSE's rallying at the moment, but I think it probably fails before 7,100, 7,200. And I think probably we're going down towards the 6,500 and potentially down to the 60, 70 area. Anyway, that's me done. I'm 17 minutes. Sorry, Neil, I should only be 15. Sorry, I forgot that 18 minutes ago. I better say important information, disclaimer, disclaims me of everything. And over to you, Neil.
Thank you, Piers. And a very comprehensive look at what has been an extremely volatile and very interesting quarter and a look ahead to what may come as far as the major markets are concerned. Now, I'm going to walk you through the economic outlook. Similar to Piers, this is going to go at something of a pace, but hopefully it will be understandable and you'll get an idea of where we're coming from in terms of how the markets have moved and how we think they may have overreacted. So if we move on to the first slide, and rather than looking at growth expectations, because I don't think many people are expecting the UK economy to grow in 2023, and it's a similar picture for the US and the Eurozone, I thought I'd just pull up these slides of where interest rate expectations have been at the August webinar, at the September webinar, and now at the October webinar. Now, this was done on Friday of last week, so you can see just how much interest rate expectations had risen, particularly in the UK, after that not so mini budget from the Chancellor. They have now come back off, but they are still materially higher than where they were at the time of the September webinar. So I think if you were to look at where markets are predicting the terminal rate to be for the UK now, it's still somewhere between 5.25% and 5.5%. They're still predicting sort of 4.25% to 4.5% for the US, and somewhere in the 3% region for the Eurozone. So it's a massive rise in interest rate expectations. And that will come with potential problems as far as both investment is concerned, but also with discretionary consumer spending. We are seeing those signs as far as the major economies are concerned. So we're seeing retailers and service-led businesses really struggling because of the combination of high inflation and increasing interest rates. There's still the prospect that over the course of the next couple of meetings, we'll get a rate rise from the US of somewhere between 125 and 150 basis points. From Europe, we're looking at it to be about 125 basis points. And from the UK, at the moment, the market is pricing in around 200 basis points of hikes between now and the end of the year, whereas we think it's probably going to be somewhere in the ballpark of between 125 and 150, but probably leaning towards 150 at this moment in time. Raising rates in an environment where there's a growing threat of recession is never a good look. And I think in part that was responsible for sterling sliding as much as it did, but there were other factors involved in sterling slide. I do think the correction in interest rates is welcome, but there's further to correct. So we look at the next slide. And here we're looking at the UK's sectors like retail sales and the index of services. I mean, I think what this starkly outlines is just how poor things have got for both retail businesses, but also for services-led businesses as well. So that left-hand chart is effectively an index of both of these things going all the way back to 2010. And what does it demonstrate? Well, it shows that after that big sort of COVID unlocking that saw a surge in retail sales, they've then tracked back lower, so that they're now considerably below where we were this time last year, and actually below the pre-pandemic level as far as retail sales volumes are concerned. If you look at the index of services, then services activity has slowed. In fact, it's actually started to contract, and we would expect it to continue to contract further as that pressure on discretionary spending builds. Even house prices, the average house price has effectively plateaued over the course of the last couple of months. We would expect house prices to actually come off as we head into 2023 and beyond. So just watch out for that as well, because I would suspect that we'll see quite a notable and noteworthy drop in house prices and also commercial real estate prices as we head into 2023, based on how much higher interest rates are and the difficulties that will cause for homeowners and businesses. Moving on to the next slide. Just thought I'd summarize some of the mini budget measures. Of course, one of those things is not happening now, which is the 45p tax rate has not been abolished, so that's been reversed. But there's still a cut to the basic rate coming in April 2023. There's a cap on energy bills, although it's not a cap, so you can't use with impunity energy. Once you hit the £2,500 limit, as some people were suggesting, then it's all free. No, it's not. It's actually a cap on individual energy prices, so that they are limited, and a standard house would likely pay no more than £2,500 per annum. That's in for 2 years, and that's probably the most considerable measure of that not so many budget. Is going to cost in the hundreds of billions. So the 2-year plan is probably going to cost around about 150 billion, we reckon. The national insurance hike was reversed. That's coming in from November the 6th. There are also cuts to stamp duty, and the planned rises in corporation taxes have also been canned. And that includes the reversal of the corporation tax hike that was brought in April 2022. They also, and this was great news for myself, and Piers, I'm sure you'll be celebrating this as well, they reversed the rises in alcohol duty, which is great news, which means that even as things get worse, it means that alcohol won't cost as much as it was going to, based on the planned duty rises. Another thing to highlight, which got a lot less airtime, but I think was actually quite important, was the reversal of the IR35 reforms for self-employed people. Now, that might well lead to a significant improvement in self-employment conditions. One of the things that we'd noticed was an absence of a return of self-employed workers, and that because of the changes to IR35, at least in part. So we might see that improving labour supply conditions over the course of coming months and quarters. So moving on to the next slide. And here we're looking at the inflation rates, which have continued to, broadly speaking, climb, although the US inflation rate does look, on a headline basis at least, to be on the downswing now, having peaked at 9.1%. And falling now down to around 8.5%. For Euroland, the inflation rate actually on Friday rose to above 10%, so it's running at 10% now, and that means that actually it's the highest of the three. UK CPI dropped from 10%. 10.1% in July to 9.9% in August. So some more positive news there. Of course, the energy price cap will be helpful in terms of reducing the peak at which UK headline inflation meets. We've also seen measures being introduced by the German government, which could put a lid on energy prices there as well, and start to put some downward pressure on inflation. But those overshoots are probably going to lead to, again, some further aggressive action from central banks, even though a lot of what's happening is not within the control of the central bank, because it's being very materially affected by geopolitical risks. So moving on to the next slide, and we look at what has happened to euro dollar and sterling dollar over the course of the recent months. A very sharp downward trend in both of these. But what I wanted to highlight here is, whilst the euro dollar downtrend was more uniform, the sterling dollar downtrend, you can see at the very end of it, it takes that sudden nosedive. That's related, as I say, in part to the problems that we saw occurring after the not so many budget, but it's also, I think, as the economic outlook has continued to materially deteriorate. And one thing I wanted to highlight, which again was overlooked by the media, who were too busy screaming and shouting about that mini budget, was that the GDP numbers that were released for the second quarter, excuse me, showed an improvement in GDP on a quarter-on-quarter basis, but the index itself was revised lower. So it means now that the UK is no longer above its pre-pandemic levels. It's about 0.2 percentage points below. Remember, the Bank of England is saying that demand is too hot. Well, it's not even back to where we were pre-pandemic. So I'm not sure how they can justify demand being too hot. And it does demonstrate, again, that this is a supply-side problem as far as the UK and the global economy is concerned. And there's a supply-side problem that probably won't go away for a number of years. Moving on to the next and final slide, our forecasts have been readjusted as far as sterling dollar, euro dollar, and a number of other currencies are concerned. I would still suggest that, from my perspective, I think that there is more downside than additional upside risk from here on in. I'm not convinced that we're done in terms of finding the lows for sterling dollar, and I don't even believe that we've actually hit an all-time low in sterling dollar, although that's what the official data suggests, that the low was around about 105.20. previously, and we obviously got to 103.5. Speaking to traders that worked in the city at the time of the 1985 lows being hit, they claim that the low was around about 101.75. So I'm not sure why the charts don't reflect that, but they have very strong recollections of those levels being traded in sterling dollar, and not the 105 level that is quoted on most systems. So I think there's more room for further pressure on sterling against the dollar, more room for dollar appreciation. I'm not buying the rebound in equities either. I think that the rebound in equities is as much a dead cat bounce as anything else, and it's being prompted by intervention by governments and by central banks, particularly the UK central bank, in terms of what they're doing with regard to buying gilts. So not convinced by any of this. Think there's further room on the downside. I think the levels that we've seen sterling dollar recently rallying above 114, sterling euro above 115, might well look quite attractive when we get towards the end of this year, because I think the risks are for a move potentially down below 110 in sterling euro, and certainly down to back towards 105 in sterling dollar, if not even lower than that. So I recognise that is materially different to the official forecasts, but I've been negative on sterling all year because I thought that the worsening economic outlook would continue to put pressure on sterling. I don't see any reason why the economic outlook is going to get that much better, even with the additional spending that the government is throwing at the UK economy. I think that the Bank of England's actions potentially put the economy in greater jeopardy than the improvement that we're likely to see on the back of what the government is doing in providing support for consumers and businesses. So that's my presentation done. There's only one more slide on my presentation, which is my disclaimer, even smaller, even less legible, but we can blow it up to any size should you wish to read it. Again, restating, we're not offering advice. We're only offering forecasts and views. Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.